The year is 2000. This company is the 7th largest corporation in the United States. Bigger than IBM, bigger than Sony, worth around $70 billion. For 6 years running, the most respected business magazine in America had named it the most innovative company in the country. Not once, not twice. 6 years in a row, its executives were treated like rock stars. Its stock sat in the retirement accounts of millions of ordinary Americans. It was by every measure that Wall Street cared about, a masterpiece. 16 months later, it was worth nothing. Bankrupt. The largest corporate collapse America had ever seen. 20,000 employees thrown out of work. Many watching their entire life savings, their pensions, their retirements, vaporize in a matter of days. While at the very top, a handful of executives had quietly walked away with hundreds of millions of dollars. And here's the part that should stop you cold. It was all fake. The profits were an illusion. The company had been hiding billions of dollars in debt in a shadow world of secret partnerships, and the people running it knew. They knew, while they were on television telling you everything was fine, while they were telling their own employees to keep buying the stock, while the people at the top were selling. This is the story of Enron, the company that didn't just lose money, it redefined what corporate fraud could even look like. It took down one of the biggest accounting firms on the planet, and it sent its leaders to prison. It left a body count. I'm going to show you exactly how they did it, and how you make a dying company look like it's printing money. How the smartest guys in the room fooled Wall Street, the regulators, and even their own staff for years, and how one woman inside the building saw the whole thing coming. She wrote it down, and then watched them ignore her. Keep one question in your head the entire time, because it's the question that eventually brought the whole empire down. If this company is making so much money, where's the cash? This is Storynomics. To understand how Enron became a monster, you have to understand that it didn't start as one. It started as a pipeline company, boring, natural gas. In 1985, a soft-spoken economist named Kenneth Lay merged two gas companies together and then built Enron. Pipes in the ground, gas flowing through them, about as unglamorous as business gets. But Ken Lay had bigger dreams, and to chase them, he hired the man who would change everything, and eventually helped to destroy it all. A brilliant, ruthless, former consultant named Jeffrey Skilling. Skilling walked in with an idea that sounded like pure genius. Why should Enron be stuck owning boring physical things? Pipelines and power plants. What if Enron became a kind of Wall Street bank for energy instead? A middleman that bought and sold contracts for gas and electricity, trading them like stocks. Not a stuffy energy company, a high-flying, trading powerhouse. An idea company. Skilling brought a weapon with him. An accounting method that is the secret engine of this entire scandal. Now, I know the words accounting method sound like the least exciting thing on earth, but stay with me for 60 seconds, because once you understand this one trick, the entire fraud snaps into focus, and you'll see it coming from a mile away. It's called market-to-market accounting. And here's how it's supposed to work. Imagine you sign a 20-year deal to supply a customer with energy. Under normal, sane accounting, you record the profit as the money actually arrives. Year by year, over 20 years, that's the reality. That's the truth. But market to market lets you do something wild. It lets you estimate how much profit the entire 20 deal will make over its whole lifetime, and book all of it as profit today. Right now, before you've earned a single dollar of it. Sit with what that means, because it's the whole game. It means Enron got to invent its own profits. They'd sign a deal, guess, rather optimistically, how much it might make over decades, and stamp that imaginary number onto this year's earnings as if it were real. Banked money. And because it was just a guess, they could make the guess as rosy as they needed. Quarter coming up short? Just assume the deal will be more profitable. Conjure the difference out of thin air. So every 3 months, Enron reported gorgeous, overgrowing profits. And Wall Street, well, they fell in love. The stock soared. The men running Enron were crowned visionaries, the smartest guys in the room. But remember the question, where's the cash? Because here's the catch, inventing the profits. The actual money never shows up. You can write profit on a piece of paper all day long, but you can't pay your bills with a prediction. And Enron's real bills were terrifying. Enormous, mounting debts from its expensive, often disastrous real-world projects. If these debts ever showed up on the books, next to the imaginary profits, the spell would break instantly. The whole world would see the emperor had no clothes. So Enron needed somewhere to make the debt disappear, and the man who built that disappearing machine is where this stops being clever accounting and becomes a crime. His name was Andrew Fastow. the chief financial officer. And if Skilling invented the fantasy, Fastow built the trapdoor underneath it. Fastow's problem was that mountain of hidden debt. His solution was breathtaking. He created a web of secret companies, partnerships with strange, almost playful names like Chuco and LJM in the Raptors. On paper, they looked like independent outside businesses, totally separate from Enron, when in reality, Enron controlled them. And in some cases, so did Fastow himself. Here's what they were for. Whenever Enron had a failing asset or a giant pile of debt they didn't want the world to see, it would quietly shove it into one of these partnerships, off the books, out of sight. And just like that, Enron's balance sheet looked clean, healthy, and glowing, while all the rot was stuffed into shadow companies hidden just out of frame. And it gets worse, almost cartoonishly worse, because Fastow was in some of these deals running the partnerships on the other side, which means Enron's chief financial officer was sitting on both sides of the table, negotiating against himself. Enron over here, Fastow's secret partnership over there, and every time one of those partnership deals closed, Fastow personally pocketed millions. He made tens of millions of dollars enriching himself through the very machines he'd built to hide the company's losses. Now, here's the detail that should genuinely make your jaw drop. None of this happened in some dark basement with blinds drawn. Enron's own board of directors approved it. They looked at a plan to let their chief financial officer secretly run private partnerships doing deals with the company, a conflict of interest so blatant a first-year business student would catch it. And they said yes. What about the auditors? This is the part that stuns people. Enron's books were checked by Arthur Andersen, one of the 5 biggest accounting firms on the entire planet, an 85,000-person global institution whose sacred job was to catch exactly this kind of fraud. They looked at all of it, and they signed off. Year after year after year. Why on earth would they? Follow the money. Arthur Andersen was earning tens of millions of dollars a year from Enron, not just for auditing the books, but for consulting at the same time. The watchdog was eating out of the hand of the company it was supposed to be protecting people from. And a watchdog that's being fed by the burglar doesn't bark. So now the machine is complete, and you can see it whole. Invent the profits with market to market, bury the debt deep in Fastow's secret partnerships, get the board and the auditors to bless every page, and to the outside world, to Wall Street, to journalists, to its own employees, Enron looked like the single greatest company in America. By August 2020, the stock hit $90 a share. Enron was worth around $70 billion. Ken Lay golfed with presidents. Jeff Skilling was the toast of Wall Street. They had built what looked like from the outside a flawless money-printing machine. But a machine like this has one fatal weakness. It survives as long as nobody asks the obvious question out loud. In early 2001, somebody finally did. She wasn't a regulator. She wasn't a rival. She was a journalist. And all she did was ask the same question I told you to keep in your head. Her name was Bethany McLean, a reporter at Fortune. She sat down with Enron's own financial filings, tried to work out how this miracle company actually made its money, and she couldn't. So she wrote an article with a headline that, looking back, was a stick of dynamite. Is Enron overpriced? It was a fair question, but calmly asked, and Enron's reaction told you everything you needed to know. They didn't calmly explain. They panicked. Skilling reportedly berated her, calling her unethical. Senior executives got on a plane to New York to lean on her editors. Think about that. Scrambling jets over a single magazine article. You don't do that over a question you can answer. You only do that over a question that's getting dangerously close to the truth. And one man had already bet a fortune that it was the truth. A famous short seller named Jim Chanos had been quietly picking through Enron's filings, and he'd reached a blunt conclusion. The whole thing was a house of cards. He started betting against the stock and telling everyone who'd listen that Enron was a fraud. Almost nobody listened. Why would you take the word of a cynical short seller over the most admired company in the country? But the doubts were spreading, and then came the moment that turned a whisper into an alarm. A moment so strange that people who watch companies for a living felt their hair stand up on the back of their necks. In February 2001, Skilling, the architect of the whole trading empire, finally took the job. He became CEO. He'd reached the summit. He'd won. And then, just 6 months later, in August 2001, at the absolute peak of Enron's power, Jeffrey Skilling abruptly quit. He said it was for personal reasons. But think about it. The man who built the machine, who swore to the world Enron was unstoppable, was suddenly sprinting for the exit. Once he got to the very top, the captain doesn't leap off the ship in calm seas. Not unless he's seen something below the waterline that nobody else has. And it turned out, one other person had seen it too. Someone still inside the building, someone who'd just done the math and gone cold. Her name was Sharon Watkins, a vice president at Enron, an accountant by training who, and this matters, had actually once worked at Arthur Andersen, so she knew exactly what clean books were supposed to look like. In the summer of 2001, as she dug into Fastow's partnerships, she found something that horrified her. One of those partnerships, called Raptor, had lost hundreds of millions of dollars. And from the way the whole thing was wired together, she could see that the losses weren't going to stay hidden. They were going to come boomeranging straight back at Enron itself. The scheme wasn't just a fraud, it was a time bomb, and the timer was running. The very day Skilling resigned, Watkins decided she couldn't stay silent. She sat down and wrote a memo to Ken Lay, the chairman, and one line of it would become legendary. Quoted in courtrooms and textbooks for the next 20 years, she warned that Enron could, in her words, implode in a wave of accounting scandals. Picture the nerve that took. A mid-level executive walking up to the chairman of the 7th largest company in America and telling him to his face that the whole glittering empire was a fraud about to detonate. She didn't just send that memo. She met with Lay personally and laid it all out. So what did Ken Lay do with the warning that could have saved 20,000 people? He thanked her. He had the company's lawyers look into it. Conveniently, the same lawyers who'd helped build the partnerships in the first place. And then, a few weeks later, he walked out, in front of the world and his own employees, and told them Enron was in the strongest shape of its life. He reportedly told staff the stock was a bargain. Buy more, load up, and here's the single most damning fact of this entire story. At the very moment Lay and other executives were telling employees to buy, they themselves were selling, quietly dumping tens, even hundreds of millions of dollars of their own Enron stock out the back door. They had the warning, they had the math, and they knew that the bomb was ticking. And their move was to get themselves out, while urging everybody else to climb further in. By the autumn of 2001, the timer finally hit zero. The cash everybody should have been asking about simply wasn't there, and the reality came out for Enron all at once. In October 2001, Enron was forced to report a staggering loss and admit it was wiping out over $1 billion in shareholder value, quietly confessing that for years, its accounting had been pure fiction. The Securities and Exchange Commission announced an investigation, and then the thing that Fastow had spent years hiding got dragged out into the daylight, those secret partnerships. Fastow was fired, and the second Wall Street understood what it was actually looking at, the collapse was merciless. Credit agencies slashed Enron's rating. A rival company, Dynegy, briefly agreed to swoop in and buy Enron. And then they opened the books, saw the true monstrous scale of the hidden debt, and bolted for the door. That was the end. The stock that had been $90 a share cratered towards zero. On December 2nd, 2001, Enron filed for bankruptcy. And at that moment, the largest corporate bankruptcy in the history of the United States, a $7 billion company, was gone. But a number on a stock ticker doesn't tell you what this actually did to people. 20,000 people lost their jobs in an instant. And here's the cruelty at the heart of it. A huge share of Enron's employees' retirement savings, their 401ks, had been tied up in Enron stock. And as the stock was collapsing, ordinary workers were locked out from selling it, frozen by retirement plan rules, forced to stand there and watch their life savings evaporate into nothing in real time. People who had given decades to that company, who were on the edge of retirement, lost everything. The average employee eventually clawed back something like 20 cents on the dollar. And at the top, in its final year, Enron paid its top 140 executives around $680 million. Ken Lay alone reportedly took tens of millions. The men who built the lie cashed out, and the people who believed in it were wiped out. The human cost climbed higher than money. In January 2002, as the investigations closed in, a former Enron vice chairman named Cliff Baxter a man who had reportedly clashed with the others over how the company was being run, was found dead. He had taken his own life. A reminder that beneath all the jargon in the spreadsheets, real human beings were being crushed in the gears of this thing. And then, there was one last giant left to fall. Arthur Andersen, the accounting firm that had been blessing Enron's books for years, were caught shredding Enron's documents as investigators moved in. The firm was indicted. It lost its license to audit public companies and effectively ceased to exist. Tens of thousands of employees all over the world, the overwhelming majority of whom had never touched an Enron account, lost their jobs because the institution built to guard the truth had chosen to help bury it. One of the 5 biggest accounting firms on earth, erased. So what happened to the men at the top? For once, the story doesn't end with them getting away with it. The government came for them. Andrew Fastow, the architect of the secret partnerships, pleaded guilty, turned on his bosses, cooperated with prosecutors, and went to federal prison. Jeffrey Skilling and Ken Lay stood trial together in 2006, and in a Houston courtroom, a jury found them both guilty of fraud and conspiracy. The smartest guys in the room were at last convicted criminals, but even the endings here come with a twist. Ken Lay never spent a single day in a prison cell, because just weeks after his conviction, before he could even be sentenced, he died of a heart attack. And under the law, because he died before his appeals were finished, his conviction was actually vacated, wiped off the record as though it never happened. Jeffrey Skilling was sentenced to 24 years, later reduced and served around 12 before walking free in 2019. Andrew Fastow served around 6, and maybe in the strangest twist of all, today, Andrew Fastow, the man who designed the entire fraud machine, travels the country giving talks on business ethics. Holding himself up is the cautionary tale. He goes around warning students about the exact kind of thing he himself perfected. But the most important person in this whole story isn't one of the men who built the lie. It's the woman who tried to stop it. Sharon Watkins was named one of the Time magazine's People of the Year, and the scandal was so vast and so corrosive to the public's trust that the US Congress passed a sweeping new law, the Sarbanes-Oxley Act, that rewrote the rules of corporate accounting and for the first time made executives personally and criminally responsible for the truth of their company's financial statements. Every public company in America still operates under those rules today. Enron's ghost is written into the law itself. So what is the real story of Enron? It was never really about pipelines, or trading, or even accounting. It's about a culture that decided the appearance of success mattered more than the truth of it. Enron's leaders were by every measure brilliant, celebrated as the smartest people in American business. And that was precisely the problem. They were so smart, so certain, that they convinced themselves the boring old rules, the ones that simply telling the truth, didn't apply to people as clever as them. They believed they could engineer a reality itself, that if you were just brilliant enough, you could make a lie come true. But you cannot outsmart arithmetic forever. The cash either exists, or it doesn't. And the day always comes. It came for Enron, and it comes for all of them. When somebody finally walks up to the vault and checks, and no amount of genius can fill an empty room. That's the lesson hiding in the wreckage. The most dangerous person in any room isn't the fool. It's the genius who's decided that the truth is just one more problem to be engineered around. That's the economics of a story, and that's Storynomics. Next time, I want to take you somewhere darker, to a company whose product wasn't a lie about money, but a lie that millions of people put directly into their own bodies for decades, while the people selling it knew exactly what it was doing to them. Subscribe, and I'll see you there.